Did you know that the little piece of plastic in your wallet is not spending your money at all? Not even for 1 second? Every single time you tap, swipe, or type in those 16 digits, you're taking out a tiny loan, and most people have absolutely no idea how that loan actually works, which is exactly why so many smart, hardworking people end up stuck paying interest for years without meaning to. By the time this video is over, you're going to understand exactly how credit cards work behind the scenes, how the bank makes its money off you, how your credit score reacts to every move you make, and how to use a credit card the smart way, so it works for you instead of against you. Hey, welcome back. If you're new here, this channel is all about breaking down money topics in plain, normal, human language, no jargon, no lectures, just straight talk about how this stuff actually works so you can make better decisions with your own money. I'm not going to pretend I'm some Wall Street guru. I'm just going to walk you through this the way I wish someone had walked me through it the first time I got a credit card. In this video, we are covering everything: what a credit card actually is, who all the players are behind the scenes, how billing cycles and due dates work, how interest is calculated and why it can sneak up on you, what your credit limit and utilization actually mean, how all of this affects your credit score, the fees hiding in the fine print, how rewards programs actually make money for the bank, and finally, the biggest myths people believe about credit cards that are quietly hurting them. Grab a coffee. Get comfortable. This is the deep dive. Let's start at the very beginning because this is the one idea that changes how you see everything else in this video. A credit card is not a payment card. It is a borrowing card. When you use a debit card, you're pulling money directly out of your own bank account. That money is already yours. You earned it. It is sitting there, and you're just moving it to someone else. A credit card works completely differently. When you swipe a credit card, the bank that issued it is paying the merchant on your behalf instantly, and then you owe that bank the money back. Think of it like this. Imagine you have a friend named Alex who is super reliable with cash. Every time you go out to eat, instead of paying yourself, you ask Alex to cover it, and Alex just keeps a running tally in a little notebook of everything he has paid for you. At the end of the month, Alex hands you the notebook and says, "Here's everything I covered for you this month. Please pay me back." If you pay Alex back in full, no big deal. He covered you for free and you are square. But if you tell Alex, "Hey, I can only pay you back half of this right now," Alex says, "Fine, but starting tomorrow, I'm going to start charging you a little extra for every day you still owe me money." That is, in a nutshell, exactly what a credit card issuer is doing. The bank is Alex. Every purchase you make is the bank paying the merchant for you. And your monthly bill is that notebook getting handed to you, asking to be paid back. Once you really internalize that a credit card is borrowed money, not your money, a lot of the numbers on your statement start making a lot more sense because you start asking the right question, which is not just what did I buy, but what do I actually owe, and how quickly can I pay it back before it starts costing me anything extra. Now here's something almost nobody thinks about. Every time you use a credit card, there are actually 4 separate parties involved in that one transaction, not just you in the store. The first party is you, the cardholder, the one borrowing the money. The second party is the card issuer. This is the actual bank or credit union that gave you the card and is lending you the money. Think of names like a big national bank or a regional bank. They're the ones who approved your application and set your credit limit. The third party is the card network. This is the company whose logo is printed on your card. The ones you have heard of that basically operate the toll roads that transactions travel down, connecting banks to merchants all over the world. The network itself is not lending you money. It is more like the highway system that the transaction travels on to get from your card to the store's bank. The fourth party is the merchant's bank, sometimes called the acquiring bank. This is the bank that the actual store uses to receive payments, and it is different from your bank. So when you tap your card at a coffee shop, here is the invisible relay race that happens in about 2 seconds. Your card sends the request through the network to your issuing bank. Your bank checks that you have enough available credit and that the transaction looks legitimate. Your bank approves it and agrees to pay. That approval travels back through the network to the merchant's bank, and the merchant's bank tells the cash register, "Approved. Go ahead and hand over the coffee." Your bank then actually settles the payment with the merchant's bank, usually within a day or two, and separately. Your bank now has you on the hook to pay them back for that coffee. Understanding this chain matters because it explains a lot of things people get confused about, like why a small transaction fee gets taken out of what the merchant receives, why some countries or some small shops do not accept certain car networks, and why disputing a charge or reversing a fraudulent transaction involves your bank going back through this whole chain to sort out. You're not just handing plastic to a cashier, you are triggering an entire financial relay race in the background every single time. This next part trips up more beginners than almost anything else. So let's slow down here. Every credit card has something called a billing cycle, which is just a fancy way of saying the period of time, usually around 30 days, that your purchases get grouped together and added up before you're asked to pay. Picture a bucket that starts out completely empty on a specific day each month. Let's call that day your statement start date. From that day forward, every purchase you make gets dropped into that bucket. This keeps going for about a month until you hit what's called your statement closing date. And on that day, the bucket gets sealed, a snapshot is taken of everything inside it, and that snapshot becomes your statement, the bill you actually see. Now here is the part people miss. The day your statement closes is not the day you have to pay. After the statement closes, you're usually given a window of time, commonly around 20 to 25 days, before the payment is actually due. This window is called the grace period, and we will talk more about why it is so powerful in the next section. But for now, just picture the full timeline like this. Day 1, your new bucket opens and starts collecting purchases. Day 30 or so, the bucket closes and becomes your official statement, and then you get a few extra weeks after that before the actual due date arrives. Meanwhile, a brand new empty bucket has already started collecting your new purchases from the day after the old one closed. This is why sometimes you make a purchase and it does not show up on the bill you're looking at right now. It is not because the charge disappeared. It is because it landed in the new bucket the next billing cycle, and it will show up on your next statement instead. A lot of people panic when they see a purchase missing from their current bill, but it usually just means it is sitting in the next cycle's bucket, waiting its turn. If there is one single concept in this entire video that can save you real money, it is this one, the grace period. The grace period is the stretch of time between your statement closing date and your actual payment due date. And here is the magic of it. If you pay your entire statement balance in full by the due date, you pay zero interest on those purchases, none, not a single cent, no matter how large the purchase was. This is the closest thing to a free loan that exists in mainstream personal finance. Let's use an example to make this real. Say your billing cycle closes on the 15th of the month, and your due date is 10 days later on the 25th. If you bought something on the 16th, the very first day of the new cycle, that purchase will not even show up on a bill until the next statement closes about a month later, and then you would have until the following due date to pay it off. In the best case scenario, you could be using the bank's money completely free for almost 2 months on a single purchase, as long as you pay your full statement balance by each due date. This is exactly how financially savvy people use credit cards to their advantage. They treat the due date as a hard deadline to pay the entire balance, not just the minimum. And by doing that, they get the convenience of not carrying cash. They build their credit history. Sometimes they earn rewards on the purchase, and they never pay a dime in interest. But here is the catch, and it is a big one. The grace period usually only applies if you paid your previous statement in full. If you carry even a small balance from month to month, many cards will stop giving you that interest-free grace period on new purchases entirely, meaning interest can start accruing on new purchases from the very day you make them, not from the due date. This is one of the sneakiest parts of how credit cards work, and it is exactly why financial experts hammer the same advice over and over. Pay your statement balance in full every single month if you possibly can, because that one habit is the difference between a credit card being a completely free tool and a credit card being an expensive trap. Okay, so what happens if you do not pay the full balance? This is where APR comes in, and I want to explain this in the simplest way possible because most explanations make it sound more complicated than it is. APR stands for annual percentage rate, and it is basically the yearly cost of borrowing money on that card, expressed as a percentage. But here is the important part. Credit card interest is not just charged once a year, it is calculated daily, using something called a daily periodic rate. To get that daily rate, The bank takes your APR and divides it by 365, the number of days in a year. So if your card has an APR of, let's just use a simple round example, 20%, your daily periodic rate would be roughly 20 divided by 365, which comes out to a tiny fraction of a percent per day. That tiny percentage then gets multiplied by your outstanding balance every single day, and it compounds, meaning the interest that gets added yesterday becomes part of the balance that interest gets charged on today. This is why carrying a balance can feel like running on a treadmill, because you're not just paying interest on your original purchase, you're paying interest on the interest that already got added. Let's walk through the logic with an example that uses no invented numbers, just the mechanism itself. Imagine you have an outstanding balance sitting on your card. Every day, the bank looks at that balance, applies the daily periodic rate to it, and adds that amount to what you owe. Tomorrow, the balance is now slightly higher because of yesterday's interest, so tomorrow's interest calculation is based on that new, slightly larger number. Multiply that process out over 30 days, and you get the total interest charge that shows up on your next statement. This is called average daily balance calculation, and most credit card issuers use some version of it. The takeaway here is not to memorize a formula. It is to understand the behavior. The longer a balance sits on your card, and the higher your APR is, the faster that balance grows on its own, even if you never swipe the card again. This is exactly why people describe credit card debt as one of the most expensive kinds of debt a regular person can carry, because the interest compounds daily and the rates tend to be much higher than things like a mortgage or a car loan. Every credit card statement shows you a minimum payment. This is the smallest amount the bank will accept without considering your account late or in default. And I want to be really direct with you here. The minimum payment is designed to keep you in debt longer, not to help you pay it off quickly. It is usually calculated as a small percentage of your balance, sometimes combined with any interest and fees you owe, and it is intentionally kept low so that the payment feels manageable. Here's the problem. If you only ever pay the minimum, the vast majority of that payment might be going toward interest rather than your actual original purchase, which means your real balance, the principal, barely moves. Picture pouring water into a bucket that has a slow leak at the bottom. If you only ever add a tiny trickle of water, you're basically just matching the leak. The water level in the bucket never really rises, meaning your debt never really shrinks. That trickle is your minimum payment, and the leak is the interest accumulating daily like we just talked about. This is exactly why it can take an extremely long time, sometimes many years, to pay off even a moderate credit card balance if you're only ever making minimum payments, because the interest is working against you the entire time. This does not mean minimum payments are useless. They absolutely matter, because missing one can hurt your credit score and trigger late fees. So if that is truly all you can afford one month, pay it. Do not skip it. But the goal should always be to pay as far above the minimum as you possibly can, ideally the entire statement balance, because every extra dollar you throw at the balance now is a dollar that stops generating interest against you for the rest of that billing cycle and every cycle after it. Your credit limit is simply the maximum amount the bank is willing to let you borrow on that card at any given time. It is not a target, it is a ceiling, and understanding the difference between those two things matters a lot. Now here is where it connects to your credit score. There's a concept called credit utilization, which is the percentage of your available credit that you're currently using. If your card has a certain limit and you have a certain balance sitting on it, your utilization is simply your balance divided by your limit. Credit scoring models pay very close attention to this number because it signals how reliant you are on borrowed money relative to what you have been trusted with. Generally speaking, lower utilization is seen as healthier. Using a small slice of your available credit suggests you are managing your borrowing comfortably, while using a large chunk of it or maxing it out completely can suggest financial strain, even if you always pay on time. Here's a really important nuance that trips people up. Utilization is typically based on the balance that gets reported to the credit bureaus, which is usually your statement balance on your closing date, not necessarily what you owe on the day you check your score. This means you could pay off your card in full every single month like a responsible pro and still occasionally see a slightly higher utilization number if you happen to spend a lot right before your statement closed, even though you were always planning to pay it off completely. Some people who are trying to optimize their score closely will actually pay down their balance before the statement closing date, specifically to lower what gets reported. Though for most people, simply keeping your overall spending well below your limit and paying in full is more than enough to keep utilization in a healthy range without needing to micromanage the exact timing. Let's connect the dots now and talk about your credit score directly, since this is probably the reason a lot of you are even watching this video. Your credit score is essentially a number that summarizes how reliable you have historically been at managing borrowed money. And credit cards play a massive role in shaping it, because they're often the most frequently used form of credit in a person's financial life. The biggest single factor is payment history. Simply put, did you pay at least the minimum on time every time? Even one missed payment reported as late can have a noticeable negative impact, and the effect tends to be worse the longer a payment stays unpaid. This is why setting up autopay for at least the minimum payment is one of the simplest safety nets you can build for yourself. It protects you from ever accidentally missing a due date, even if you plan to pay more manually. The second major factor, as we just discussed, is credit utilization. Keeping your balances low relative to your limits signals healthy borrowing behavior. The third factor is the length of your credit history, how long your accounts have been open and active. This is exactly why financial educators often say think twice before closing your oldest credit card, because closing it can shorten your average account age and potentially affect your score, even if that card is not your main one anymore. The fourth factor is your credit mix. Having a healthy variety of credit types over time, like a credit card alongside something like a car loan or student loan, can be seen positively, though this factor carries far less weight than payment history or utilization. And the fifth factor is new credit inquiries. Every time you apply for a new credit card, the issuer typically performs what is called a hard inquiry to check your credit, and having several of these in a short period of time can be seen as a small risk signal, since it might suggest you're suddenly seeking a lot of new borrowing capacity. None of these factors alone tells the whole story. Your score is really a blend of all of them working together over time, which is exactly why consistency matters so much more than any single clever trick. Interest is not the only way a credit card can cost you money. There are several fees worth knowing about, so nothing catches you off guard. The annual fee is a yearly charge some cards apply simply for the privilege of holding that card, often in exchange for stronger rewards or perks, while plenty of other cards charge no annual fee at all. So this is very much something to compare before choosing a card. The late payment fee is charged if you miss your due date, on top of the potential damage to your credit score we just talked about. So this is really a double penalty. First, the fee itself, and second, the possible credit score hit. The foreign transaction fee is a small percentage added on to purchases made in a foreign currency or processed through an international bank, which matters a lot if you travel, since some cards are specifically designed to waive this fee for travelers while others are not. The cash advance fee applies if you use your credit card to withdraw actual cash from an ATM, and this one deserves special attention because cash advances are treated very differently from normal purchases. They often start accruing interest immediately with no grace period at all, and frequently at a higher interest rate than regular purchases. Plus, there is usually an upfront fee just for making the withdrawal. This is exactly why financial educators tend to say avoid cash advances unless it is truly an emergency, because the cost stacks up from multiple directions at once. Knowing these fees exist is not about being scared of credit cards. It is about reading the terms of your specific card so you know exactly what triggers a charge and what is not, because the fee structure can genuinely vary quite a bit from one card to another. A lot of cards offer cash back, points, or miles as rewards for spending, and people often wonder if the bank is giving me money back. How are they still profiting? The answer lies in something called an interchange fee. Every time a merchant accepts a card payment, they pay a small percentage of that transaction to the card networks and issuing banks as a processing cost. This is baked into the price of doing business and is a major revenue source for banks, completely separate from the interest they charge you. So when a bank gives you cash back or points, a portion of what they are handing back to you is coming from that interchange revenue they're already collecting from the merchant on every purchase you make, rewarded or not. On top of that, rewards programs are also a strategy to encourage more spending on that specific card and to encourage cardholders to stick around and keep using it as their main card. And of course, if a cardholder ever carries a balance, the interest charges on that balance can easily outweigh whatever rewards were earned. This is exactly why the golden rule around rewards cards is simple. Rewards are only a genuine win if you're already going to spend that money anyway, and you pay your balance in full every month. Chasing rewards while carrying interest-bearing debt almost always costs you more than the rewards are worth. Let's clear up a few misconceptions I hear all the time, because these genuinely trip up well-meaning people. The first myth is that carrying a small balance on your card instead of paying it off in full helps your credit score. This is simply not true. There is no credit scoring benefit to paying interest. Your score responds to on-time payments and healthy utilization, not to the bank collecting interest from you. Paying your statement in full every month is always the better move for both your wallet and your score. The second myth is that closing an old credit card you do not use anymore is automatically a smart, tidy financial decision. In reality, closing a card can reduce your overall available credit, which may raise your utilization percentage on your remaining cards, and it can also shorten the average age of your credit history over time, both of which can potentially lower your score. So it is often worth considering keeping an old, no-fee card open and just using it occasionally instead of closing it outright. The third myth is that checking your own credit score or credit report hurts your credit. Checking your own information is generally considered a soft inquiry and does not affect your score. This is completely different from a hard inquiry that happens when a lender checks your credit because you applied for new credit, so do not be afraid to check in on your own score regularly. Staying informed is always a good habit, not a risky one. So that is genuinely how credit cards work from the moment you tap your card to the moment it shows up as a line on your credit report. If this video actually made things click for you, do me a favor and hit that subscribe button, because this channel is all about breaking down exactly this kind of stuff in plain language. No jargon, no fluff, and I have a lot more of these breakdowns coming. Drop a comment and let me know what confused you most about credit cards before this video, or if there is another money topic you want broken down like this next. I read every single comment, and a lot of my future videos come directly from what you all asked for. And if you know someone who just got their first credit card, or someone who has one and still feels a little lost about how it actually works, send this video their way, because understanding this stuff early can genuinely save someone years of unnecessary stress and interest payments. At the end of the day, a credit card is not good or bad on its own. It is just a tool, and like any tool, it does exactly what the person using it decides to do with it. Understand how it works, respect the mechanics we covered today, and it can genuinely work in your favor for the rest of your financial life. Thanks for watching, and I will see you in the next one. This video is for educational purposes only and does not constitute financial advice. Please consult a licensed financial professional